So you're ready to buy your first home. That's amazing. It is a huge, exciting step, but then you start hearing acronyms like APR, ARM, PMI, and suddenly your excitement is buried under a pile of confusing financial jargon. Let's be honest, it can feel like the whole world of interest rates was designed to be as complicated as possible. But what if I told you that in just the next few minutes, you could learn the key secret to not only understand these numbers, but to feel totally confident you're getting a great deal? Stick around because we're about to break it all down. Let's start with the absolute basics. An interest rate is simply the fee you pay for borrowing money. Think of it as the bank's charge for lending you a huge chunk of cash. But the number you really need to watch is the APR, or annual percentage rate. So why is APR so important? Because it includes not just the interest, but also other lender fees and loan costs. This gives you a much more complete picture of the loan's true cost. You could have two loans with the exact same interest rate, but different APRs. The one with the lower APR is just cheaper, period. All right, now that we know what a rate is, let's talk about the two main flavors of mortgages. First up is the fixed rate mortgage. This is the most popular choice for a reason. It's simple and stable. Your interest rate is locked in for the entire life of the loan, whether that's 15 or 30 years. Your main payment of principal and interest will never change, which makes budgeting a breeze. That predictability is golden for first-time homebuyers. Then you have the adjustable rate mortgage, or ARM. These loans usually tempt you with a lower interest rate for the initial period, like 5 years, but after that, the rate adjusts with the market, which means your monthly payment could go up or down. While that initial low payment is attractive, you're taking on the risk that your payment could become a lot less affordable down the road. Ever wonder why your friend got a different rate than you? It comes down to a mix of big picture economic forces and, more importantly, your personal financial history. Things like the economy, inflation, and Federal Reserve policy set a baseline for rates. After some rate cuts in 2025, we've seen 30-year fixed rates level off. As of late January 2026, the average is hovering around 6.1 to 6.2%. But here's what you can actually control: your financial profile. To a lender, it's all about risk. The less risky you look, the better rate you'll get. The two biggest factors by far are your credit score and your down payment. A great credit score shows a history of being responsible with borrowed money. Lenders typically reserve their best rates for borrowers with scores of 740 or higher, though you can often get a conventional loan with a score of 620. Your down payment is the other heavy hitter. A larger down payment means you're borrowing less and the lender is taking on less risk. If you can put down 20%, you'll not only get a better rate, but also avoid paying private mortgage insurance, also known as PMI. If you're starting to feel like you got this, do me a favor and hit that subscribe button. I release new guides for first-time homebuyers all the time to help you feel empowered on this journey. Okay, let's turn all this knowledge into action. What can you do right now to get the best possible interest rate? First, get your financial house in order. If your credit score isn't quite where you want it, start focusing on paying every bill on time and tackling high interest debt like credit cards. Even a small boost to your score can save you thousands over the life of the loan. A score over 620 is typically the minimum for a conventional loan, but new rules are making it possible for some lenders to approve scores even lower than that. Second, and this is the most important tip, shop around. Don't just walk into your personal bank and take their first offer. Get pre-approved with at least 3 to 5 different lenders. Check out mortgage brokers, credit unions, and online lenders. You'd be shocked at how much rates can vary for the exact same loan. This is the single best way to make sure you're not leaving money on the table. If you need some lender advice, definitely drop me a comment and I can send some lender information your way. Third, look into special loan programs. There are some fantastic options out there for first-time buyers. FHA loans, which are backed by the government, allow for down payments as low as 3.5% with more flexible credit requirements. There are also conventional loans that require only 3% down. You do need a certain credit score for that. And if you or a family member served in the military, a VA loan could let you buy a home with zero down payment. I know, this is a ton of information, but it really boils down to this. Understand the difference between fixed and adjustable rates. Focus on the things you can control, like your credit and savings, and be proactive by shopping around for the best deal. Buying your first home is a massive achievement. You don't need to be a financial genius to do it right. You just need to be an informed, confident buyer. For a final tip, find an online mortgage calculator and play around with it. Plug in different home prices, down payments, and interest rates. It's the best way to see for yourself how these numbers directly impact your monthly payment. I've dropped a link to one in the description. Good luck and happy house hunting. Thanks for watching.